Okay, hello, everybody. This is our discussion of Chapter 19 in the text. And this deals with distributions from corporations, not incomplete liquidation. We'll get to in Chapter 20 discussions of liquidation as affecting the corporation. What we mean by liquidation is that we're talking about the entire corporation not being liquidated. We'll see some instances here of individuals liquidating their entire positions, but those are individual shareholders, not the complete company itself. And so that's really the distinction here that we'll be talking about. Many of these distributions are going to be treated as dividends, and some will not be. So will be considered return of capital. And so we'll get into that, explore some of those distinctions. I think you'll find, if you've been reading this chapter, that a lot of the discussion is about the tax effect on some of these distributions on individual shareholders, much more on the corporation, very much more on the corporation. So we'll definitely get into some of the effects on the corporation, but a lot of these have impacts on shareholders themselves. Many of them having to do with closely held companies where there are few shareholders. Some of these issues do relate to publicly traded corporations, particularly when we get into things like qualified dividends. But for the most part, these are some of the most germane issues here. And so let's get into it. Let's talk about this entire issue of what's going on with distributions to shareholders. And so we're going to cover some of these things here. We'll talk about earnings and profits. This is a concept that really, I think, only begins to be explored in this particular segment of the class. And what earnings and profits basically is, how it's calculated, and we'll talk a bit about what it looks like. I think sometimes we think of earnings and profits as being analogous to retained earnings in the GAAP accounting world. And it's similar, but there are differences, and we'll talk about what some of those differences are. Things that have to be added back, things are subtracted in order to arrive at earnings and profits. And earnings and profits is this cumulative number. There's a cumulative number, then there's also a current year's earnings and profits, and we'll get into that. We'll talk about taxable dividends paid, and we'll allocating it between the current and accumulated. And then all the various issues concerning the tax treatment of dividends to individual shareholders as they are paid out. We'll also talk a bit about property dividends. This is not as common, I think, the idea that distributing actual physical assets or something of value, some asset to shareholders, but nonetheless, there are tax rules that deal with that. And again, as I think I mentioned before, some of these transactions may be obscure, but if they weren't defined, then nobody would know how to treat them. And so as a result, there are rules for lots of things. And there occasionally are issues that come up, which is why we have tax courts, issues that are novel, that nobody's seen before. Maybe there's a difference in opinion between the taxpayer and the taxpayer's accountants and attorneys and the government itself. And this is why we have tax courts and in order to sort of resolve these problems. But for the most part, most situations are fairly common and are not going to involve novel interpretations of law. We'll talk about the issue of constructive dividends and what that means. Basically, it's a reinterpretation of a distribution, and therefore the entire transaction is considered to be something different than what it was intended to be. We'll talk about stock dividends a bit and the rights of stockholders. We talked a bit about stock rights before, and we'll talk more about that. We'll also talk about some redemptions. We'll talk about the effect on redemptions, both that they qualify for sale exchange treatment, which is different than that, treated differently when it is not considered sale or exchange treatment. And then the final bit here, we'll get into some planning opportunities. And I think tax planning issues really are sort of the place where a lot of tax practitioners can add value to what it is that they do. It's one thing for us to be able to prepare tax returns. It's quite another thing for us to be able to advise clients on some of the implications of the tax positions that are being taken, what some of the long-term ramifications are, and whatnot. So there are really some important things that we need to be considering. And I think a good accountant can really add value to client service when it comes to this. As a tax person, I always thought that it's one of the services where clients are often very grateful for what we do, even though, yeah, it costs them money. But we explain very complicated things to them, work things out so that they can take the best advantage of tax laws to avoid taxes where possible, not to evade taxes, but to avoid taxes. And in that way, we can add a lot of value. Okay. All right. So let's talk a bit about distributions. Distributions basically in other words, from the corporation to individual shareholders are assumed to take the form of dividends unless they're otherwise indicated. Okay. I think that's sort of the default position. And they're paid out of what are called earnings and profits. We'll get back to this here more in a second. And either their taxes or their income, which would typically be the case for a corporation receiving a dividend. Of course, corporations get a dividends received deduction, or as if it's an individual, a preferentially taxed dividend, 0, 15, 20%, whatever the tax rate is, depending upon the individual. If we're talking about the shareholder receiving the dividend is an individual, that party will then, get married, finally joined, or single, whatever, or taxed at whatever rate applies based upon their income. And it's a marginal rate. And so typically those are, they receive a preference. And we'll talk a bit about why this is part of public policy to tax dividends at a lower rate than ordinary income, like wage income and, and business income, things of that nature. Okay. Distributions are not treated as dividends when they become a tax return of capital. And we're going to talk about this idea of when dividends are no longer dividends because there are no earnings and profits left to pay them out of. And so as a result, then it becomes a distribution back to shareholders of their basis. And when that's gone and the company is still distributing, then it becomes a gain from the exchange. In fact, any kind of distribution you get in excess of your basis has got to be considered a gain. And so as a result, that's typically the order in which the taxability of those to individual shareholders is received. Okay, so let's talk a bit about earnings and profits. We've sort of mentioned that before. It's further defined in the tax code, 26 USC section 312, and there's really no good definition. I know when Congress made the determination of earnings and profits, it probably is a term that would not be developed today. I think there's no single definition, but it's defined in terms of what is taken as retained earnings in the GAAP accounting world, and then with some other things that are added to it and subtracted from it in order to get to what it is. It is analogous to retained earnings, and in fact, as your textbook notes, that some corporations don't even bother to compute retained earnings and profits. And that's not a great thing to do because of the fact that sometimes earnings and profits can decline. They could be zero, and yet retained earnings can be some different number. So I think it's a very important thing to do. And this is why tax professionals can be instrumental in this regard of being able to calculate it. So it includes both accumulated, which goes all the way back to whenever the company started, or the beginning of the tax code, as we'll see in a second, and also the current year's earnings and profits. Okay, and it really, what does it represent? It really is the maximum limit that can be distributed to shareholders and in the form of dividends, and have them being treated as dividends. And it also represents essentially the economic ability to pay those dividends in the first place. That is, you shouldn't be paying dividends out of non-existent retained earnings, or in this case, earnings and profits. So when we start with and we won't. I think the way to look at this is taking current year's look at earnings, and then if we adjust those, then we can know where the accumulated earnings and profits come from, because really the definition hasn't changed for a very long time. And so simply put, it's an addition to or subtraction from accumulated earnings and profits. But let's just assume that we're earning income, and so as a result, we're going to be adding to the accumulated earnings and profits, or again, very analogous to retained earnings. So it begins with taxable income generally, and with some adjustments. The additions to those are things like tax exempt interest. Why would we have to add that back in? Because it was never taxed in the first place, but it does represent economic value to the company. The company has earned tax exempt interest. It was not part of taxable income, but nonetheless it should be added back in. Life insurance proceeds, which are not taxed. And a lot of times companies will purchase insurance on key people, and what used to be called key man insurance or key person insurance. And that is, you've got somebody who's considered to be a major player within the corporation, brings a lot of talent, skills, experience, whatever, and that person's loss is is a real detriment to the company. And so a lot of companies will take out life insurance policies, often very large ones, on their key people. And the beneficiary is not that person's spouse or children, and whoever, it's the company itself. And it's the company itself that pays for it and also gets the proceeds, but the proceeds are not taxable, yet do represent economic value. So that goes back in the EMP. Federal income tax refunds, again, goes back in the EMP. And the dividends received deduction add back is actually logical, since it's really only a tax provision, has no economic bearing on the company. And yet companies, we're talking about corporations here, can take the dividends received deduction and also be able to add that back. So those are some of the add backs. Here are some of the subtractions. And these are some of the things which are really non-deductible, and a lot of them have to do with entertainment expenses and whatnot. So things like meals, entertainment, a lot of times meals are for travel-related meals, expenses occurred to produce tax-exempt income, any federal taxes paid, and the premiums on those life insurance policies. And then any kind of non-deductible fines and penalties, etc. Lobbying expenses are non-deductible, and so as a result, those are subtracted from E&P. I mean, we know that companies cannot deduct fines and penalties, and that's part of public policy. We don't want taxpayers to be able to deduct something which is owed to the government as a result of some conduct which is considered to be contrary to the public interest. Why would you counter the public interest by doing something like that? So that's essentially what's going on there. So, and then some E&P adjustments do move or shift these effects from one tax year to another. Charitable contributions, if you've taken intermediate accounting, you might recall that sometimes companies will declare a charitable contribution. And I think we got into this in some of the earlier chapters as well. They could claim it in a year and be able to take a deduction, but not actually pay it until the next year. And so as a result, you know, there's a difference in timing there. Net operating losses, and we actually covered that beginning in 2320, I do believe, where a net operating loss can be incurred, but then it can't be claimed. It has to be rolled forward as a loss carry forward. And that's an issue of shifting. Also capital loss treatment, where you cannot offset capital losses with any capital gains. And so those losses do not get counted as a result, at least for tax purposes, in the year in which they're incurred. And so generally, these only affect earnings and profits only to the extent recognized for tax purposes. And so one other one is like-kind exchanges. We got into a little bit of discussion about like-kind exchanges, which were somewhat similar to the 351 transfer of fair market value from a shareholder to a corporation. Like-kind exchanges, though, are more a true exchange, where it's not just property for stock, it's property for property and whatnot. So those gains there typically don't affect earnings and profits until they're actually recognized. And then some other adjustments to this. This is one of the more interesting pieces of this, is the idea that there's an adjustment for things like depreciation. And as your text has noted, that the accounting for the inclusion of earnings and profits is a bit more conservative than it is under GAAP accounting principles. The installment method, this is typically an installment sale, is not permitted. Also, the alternative depreciation system, ADS, is used. ADS is basically straight line depreciation with a half-year convention, as opposed to a maker's depreciation, which is accelerated depreciation. It's basically double declining. And you can have, say, a make-order convention, for instance, and whatnot. So this is a more conservative and a slower amount of depreciation. Typically, straight line, by definition, is going to be a slower rate of depreciation than is the case under accelerated methods. And so ADS is typically used when depreciating depreciable assets. Also, the 179 expense. Section 179 is simply this issue of immediate expensing. And the limits on that, I think, I believe this tax year's 2.1 million something. It changes every year. It's gone up dramatically. This 179 deduction, I think, when I first started doing taxes, forever ago, I think it was like 75,000, and somebody told me it started at like 35,000. Now it's in the millions, so it's gone up. It's immediate expensing. Here, though, for our purposes, Well, for purposes of computing EMP, it's a 5-year depreciation on that rather than the immediate expensing. So that is a bit slowed down in that regard. Again, it's a more conservative sort of treatment in this regard in that direction. Okay. And there's an example in the text. If you want to take a look here, hopefully I can find this for you. Here's an example. This is example 7, and you can look at this in chapter 19, where in this case you have a corporation that bought some equipment and had a 10-year midpoint life, had a maker's class life of 7 years. That only defines, the Cloudner tables define the class life depreciation period for assets under makers. And so notice here you got a maker's deduction, which is a lot bigger than the ADS, which is a straight line deduction. So there's an adjustment made for that, the difference between this and this. And the same goes the next year, because obviously the second year, the maker's really deduction really kicks in. And so you got a different element. I think this was actually purchased. I'm sure exactly when it was purchased. It was also disposed of. But this is an example of how the different treatment is done in terms of treatment for ADS. I'm sorry, for treatment for EMP purposes using ADS as opposed to the maker's system itself. Okay. All right. Oh, and also first year depreciation. First year depreciation, which sometimes is called bonus depreciation. Sometimes it's called that. I think that the IRS is sort of moving away from that description, calling it now first year depreciation as opposed to bonus depreciation. The difference between that and 179 is the fact that bonus depreciation or first year depreciation can be changed pretty quickly, and or can be taken away altogether. In fact, we've seen it be bumped up in recent years, but it's not as codified into law as is the 179 deduction. And there's an order in which you take depreciation for tax purposes, and usually starting with that first year depreciation, then 179, and then the remaining under makers. And all we're doing here is simply adjusting earnings and profits for a more conservative approach as to the company's ability to pay dividends, which is reflected therefore in earnings and profits, a little bit more conservative measure in that regard. And then anything that exceeds earnings and profits receives a different tax treatment. It's basically return of capital at that point. Okay. And then the final bit here is depletion. I really don't want to get into a lot of this because it's a bit beyond where we're going to go in this course. When we talk about depletion, it's essentially it's an allowance. It's similar to depreciation, but it reflects it's reflective of extractive industries, oil and gas, timber, and it's a little bit different in this regard. My grandfather was in the coal mining business, and so heard a lot growing up about depletion allowances and whatnot. But in this case, there's a cost depletion measured rather than the percentage depletion. If we really want to get into that, you can get with me. It's not something that's, I think, a big issue here. I don't think it really comes up all that frequently, but it is something to talk about. Also, amortization of organizational expenses is not allowed. Now, remember, as you're starting a company, you can some of the cost of organization, typically legal fees, accounting fees, these are capitalized as organization expenses and amortized for GAAP purposes. Now, in this case, this is not allowed for EMP purposes. Also, adjustment is required for changes in the LIFO recapture. And we should talk a little bit about that, because I know that one of the more challenging aspects pretty much everywhere in accounting has to do with inventory valuation, with particularly this issue of LIFO versus FIFO. And of course, we're pretty much the only country now that uses a LIFO system in GAAP accounting. Well, of course, GAAP is unique to the US pretty much, but the rest of the world does not use LIFO, but nonetheless we do. And so there are differences. And so the LIFO recapture is basically the difference between, well, the entire calculation, say, ending inventory using FIFO and that using LIFO. And then if the inventory is different, then it means cost of goods sold is different, which means net income or gross profit is going to be different, that resulting from inventory transactions. And so it's the difference between using FIFO and that using a LIFO. So for instance, ending inventory under FIFO is going to be greater than ending inventory under LIFO. And as a result, under FIFO, cost of goods sold is lower because they have a higher ending inventory, and net income is higher. Okay, so what happens here is the key issue is that they, with all of these things, they're sort of serve to reflect the ability of the company to pay dividends, and so we want to reflect this difference in FIFO and LIFO. Okay, without getting into a lot of the details in this, and I know that in GAAP accounting, this becomes a really serious issue when you have a LIFO treatment and you have the difference between FIFO and LIFO valuation that goes on year after year after year, and you have this sort of LIFO reserve that builds up over a very long time period. In this case, all we're simply doing is making the adjustment here, the difference between those two figures. Okay, but all of it really represents the ability of the company to pay dividends under a more conservative approach. In the slide presentation that is in your text, I won't do this line by line, but you might go and flag this a little bit. These are, and of course, you have also access to the slide presentation itself. But just kind of take a look as what the effects are on earnings and profits. So additions and subtractions. Some of these we talked about. Some we didn't, like losses on sales between related parties. There are some pretty thick weeds here to kind of go through, and it goes on and on and on. So you might want to take a look at it for yourself, just to kind of, get a feel for the differences between GAAP accounting for retained earnings and tax accounting for earnings and profits. Essentially, what's going on is this, and this is not a new idea, but it's the idea that for tax accounting purposes, the corporation really needs to have a separate set of books to handle, their tax. Their tax software should be something separate from their financial accounting software. And this is nothing new. In fact, there are lots of different software programs out there, but the calculation of earnings and profits is a good idea. In fact, what happens is sometimes corporations, particularly as they begin to fail and start to move toward failure, earnings and profits become very, very thin. And then it becomes an issue. Hey, what are your earnings and profits? If the company's been around for a while, it's truly a nightmare to try to reconstruct what earnings and profits are. And so doing this for a C Corp early on makes a lot of sense and is definitely advisable. Okay. All right. So we talked a bit about current earnings and profits, and this is essentially not all that different with the exception of the adjustments we talked about with regard to additions and subtractions, but it's currently basically taxable income, and based upon those adjustments, accumulated earnings and profits is very similar to like the balance sheet account of retained earnings. All the prior year's current earnings and profits, or at least those since February 28th, 1913, reduced by any distributions that may have come out of earnings and profits. And this date really reflects the reintroduction of the income tax code in the U.S. Income tax code for a bit of time during the Civil War, that went away, and the tax code came back into effect. And you might be thinking, 1913, my gosh, I mean, what companies are we talking about? Well, actually, there are quite a number of companies that are way older than 1913. Some of the biggest companies that we know of have been around for even longer than that. I think Pfizer, the drug company, has been around since the 1840s. Procter & Gamble since the 1850s. A lot of these companies have been around for a very long time. So beginning with that particular date when the tax code went into effect and setting up earnings and profits. And by the way, GAAP accounting is still it's really sort of in its infancy, to tell you the truth. And if you take an intermediate accounting, you will have gone through this discussion of all the various regulatory bodies that have come up and the different changes in GAAP accounting. And so really, in a lot of ways, it seems like tax accounting may be a little bit older in terms of some of the standards than what actual financial accounting standards are. Not in every instance, of course, but because there's been an effort obviously to standardize financial statements, but it is an important consideration. And also distinguishing between the current and accumulated is important because distributions really depend upon, are we taking them out of current? That's really the first order here, as distributions, say dividends, for instance, or are we taking out accumulated earnings and profits? So we need to understand where we're drawing from, and the difference is going to be important, and we'll get to some of those differences here in just a bit. Okay. Okay, I'm going to skip some of the knowledge checks because I think it's sort of is a little bit, you can see for yourself what's going on. And I'd rather sort of spend some time talking more about some of the topics themselves. And so here we're going to talk about these distributions and how we allocate earnings and profits to those distributions. Where do these distributions come from? Well, first of all, we're assuming they're coming out of earnings and profits. And so that's really the first assumption. And we're assuming too that we're probably talking about dividends, but we really don't know until we examine the facts. So if there's a positive balance in both the current and accumulated earnings and profits, then the distributions are considered, deemed in this case, to be first from current and then from accumulated E&P. Okay, that's just the order of distribution. The most current earnings are the ones that are most distributed first. And this is a very common scenario where there's a positive balance in both current year's E&P and accumulated E&P, and there's some kind of distribution out of it. And first it comes out from, and the first distributions are considered to be out of current, and then anything over and above that might be, or will go to accumulated E&P. If they exceed the current E&P, then you have to allocate that between the current and the E&P. And there's an example here we'll get to talk about how that works. And it's done on a prorated amount, that is using dollar figures in order to do that. The best example that I can show you here is to go to, this is example 10 in the text. If I can show you, this is an example of a company that had a fairly small amount of accumulated earnings and profits, $10,000. This is example 10 in chapter 19. Current E&P for the year was $30,000, and it's deemed to have been earned evenly throughout the year. Okay. Megan and Matt are sold equal shareholders. August 1st, Megan sells her stock to Sandra. And Black, which is the company, makes two distributions during the year: $40,000 to Megan I'm sorry, $40,000 to Megan and Matt together. That is $20,000 each on July 1st. So essentially, what's going on? The July 1st distribution, in this case, it basically zeroes out the firm's earnings and profits, both current and accumulated. Any excess then becomes what? Becomes a return of capital, which essentially is non-taxable to shareholders. And the reason it's non-taxable is because presumably this stock investment had been taxed at some point in the past. And so it's non-taxable, but it does, however, reduce their basis. I say their, meaning their shareholders' basis, and it becomes return on capital, because this distribution here basically takes earnings and profits down. Why? Because we're assuming that income is earned evenly throughout the year, and so half of a year of 30,000 is 15,000. So as a result, that distribution is going to take it out, and then we're going to have another portion that's going to reduce. It's going to be essentially considered to be a return of capital. So that's the order in which this happens. This is obviously a very thinly capitalized company. You might be thinking, well, okay, thinly capitalized companies, who cares really? I mean, this is a company that may not, looks like it's teetering and tottering. And what are they doing? Taking money out of the corporation. Well, okay, those are fair arguments, but I will say that there are a lot of companies that don't have a lot in earnings and profits. And I'm thinking about a lot of service companies. I'm thinking a lot of professional companies, law firms, accounting firms, etc. Among those ones that I know fairly well, that don't need to have a lot of earnings and profits, because there's not a great need to reinvest in things like new equipment and fixed assets and vehicles, and there's no inventory. So I bring up service businesses as a particular example over here. I'm not saying there's no reinvestment into capital assets and all, like computers and whatnot, but it's not as great as it is in a manufacturing organization or even a merchandising firm that has inventory. So a lot of companies are very thin on E&P, and it does become an issue as to, hey, what is this distribution? Is this out of current year's E&P? Is it drawing down against accumulated E&P? Or is this actually a return of stockholders' basis to those shareholders as we're making these distributions? So this can come up particularly, and I bring this issue up only because thinly capitalized companies are not necessarily skating on thin ice. It's just that they don't really need to have lots and lots of capital, because to do what? I mean, there's really nothing there. And we'll see a bit later how the Tax Cut and Jobs Act treats some of these organizations, and particularly their tax treatment, which is a little bit different than other companies like manufacturers or or merchandisers or whatnot. And we'll get to those a bit later. Some of them are treated more as almost like wage income than it is corporate income, but more on that later. Okay, so that's essentially what's going on there. So the July 1st distribution basically takes out the firm's E&P, and when we talk about these distributions, there is an issue about when tax years of the corporation and the shareholder is not the same. And this does happen at times because a lot of times companies can file with the IRS to say, we don't want a calendar year tax year. We need a different tax year. And there are some good reasons for that. Kind of going back to financial accounting, where a company will choose a year end that sort of captures the majority. Well, particularly if it's a cyclical business, they don't want to take that business cycle and split it into 2 different years for a lot of reasons, for comparison purposes and whatnot. So something like a ski resort might not want a December 31st year end. They might want I don't know, April 1st year end or whatever. So there are cases which companies are going to have a different year end than the shareholders, and it may be very difficult to determine or E&P in this kind of this kind of situation. And all we're really saying here is that sometimes it is difficult and it is challenging, and it can be pieced apart, particularly if the IRS has some issues with what a distribution is and what to do with it. But the assumption is first made that current earnings or profit is sufficient to cover distributions, and then those are defined as dividends, and then taxed to shareholders as such. Okay. All right, and again, this issue of if current E&P is positive, accumulated E&P is a deficit, then accumulated E&P is not netted against E&P. Instead, it's deemed to be a taxable dividend up to the current E&P balance. Okay, if the accumulated E&P is positive, the current E&P has a deficit, which is not unusual. Again, for thinly capitalized companies, you would net both of these at the date of distribution. There's an example or a couple examples, I think, in the text about this. And if the balance is 0 or negative, then any kind of distribution is by definition return of capital up to the extent of that person's basis, any shareholder's basis. And then over and above that is considered a gain. You know, why wouldn't it be? Because any kind of benefit you get on an asset that exceeds the basis of that asset is going to be considered to be a gain in this case. And if the balance is positive, then it's a dividend to the extent of the balance. There's no problem there. And any kind of deficit in E&P is allocated throughout the year based upon earnings throughout the year. And there, again, we looked at a little bit of an example a second ago, but there are other examples you can look at. If you want to get with me individually on some of this, I'd be more than happy to discuss some of those with you. Okay. All right, so that's a little bit about E&P, and this is an example of a cash distribution. So how do we treat this situation? So in this case, we have here's the example: $20,000 distribution is made at the end of the year, and we have 3 different situations, all of which are considered independent of one another. That is, there's no one does not lead to 2 or 3 or whatever. So in the first example, the accumulated E&P is going to be $100,000 at the beginning of the year. They earned $50,000 in E&P throughout the year. Dividend of $20,000, no big deal. It's easy peasy. All it is simply a distribution out of current E&P, and the remainder then becomes part of accumulated E&P as we go forward. So nothing too tricky on that. In the second one, we had a deficit at the beginning of the year, and we had current E&P, but again, it was a $20,000 dividend, so it's still considered a $20,000 dividend because it comes out of current E&P first. That's the order of things. And the third situation is we had a beginning earnings and profits of $15,000. We had a loss actually, so a negative E&P. So the dividend in this case is only $5,000. And because there's a deficit, these are they net themselves out here. Okay. And that's really what the important thing to note is that these 2 figures are netted out. And you did have some beginning, but then you're actually getting rid of accumulated E&P as the year goes on, okay, or as this distribution is made. Okay. All right, and so let's talk a bit about dividends here and what they're about, and we'll talk about this idea. There's some tax theories, some tax logic here, which I think is important to talk about, and that is that corporations, particularly corporations receiving dividends, are taxed as ordinary income. This differs from the treatment of taxation of dividends to individual shareholders, whether single, married, filing, joint, whatever. They receive a different tax treatment. It's a preferential rate. Corporations, however, do get dividends receive deduction. And some of the logic of this is that that dividends are taxed more beneficially than ordinary income, like wages, for instance, and even interest, because the idea that we don't want to create a disincentive to not invest in corporations, and corporations tend to be more subject to regulation and oversight, particularly, well, definitely publicly traded corporations, and so it's in the public interest to be able to know what's going on, to be able to regulate these and oversee them a little bit better. When they're corporate entities than they're corporate entities. There's also an incentive for companies to finance operations with debt as opposed to equity. We got into this a little bit in Chapter 18, and it is the case that if a company finances with debt, any debt holder is going to earn interest and therefore is going to pay a higher tax rate. So the problem with that is that there's a public interest in not having debt disguised as equity. And there are a lot of examples that we got into in Chapter 18 on this. And in this case, it's in the interest of the government and the public interest generally to have equity be considered equity, debt be considered debt, and too much debt is not a good thing, because too much debt is too much what we call financial leverage, and the company can become very unbalanced and therefore fail. And so the problem with debt as opposed to equity is that equity is much more flexible as a financing mechanism. Dividends can be withheld, they can be canceled altogether, they can never be paid at any time. Some companies never paid a dividend and have no intention of paying a dividend, whereas debt payments are contractual obligations that lock borrower and a lender in. So the borrower in this case is really stuck with having to pay it, even whether they like it or not. They just can't really avoid it. Okay. All right. And then the other economic incentive here is that there is an incentive for companies to retain earnings and structure distribution of profits in different ways as opposed to dividends, in order to avoid the double tax. Remember, the double taxation is this idea that a corporation earns income, pays tax, and we're talking about C corporations, not passive entities like S corps. They earn income, they pay tax on the income, then they distribute earnings in the form of dividends, which are actually not dividend distributions. They're distributions of capital generally, but they're considered to be analogous to distributions of income, which is why the EMP treatment treats current EMP distributions first, as opposed to accumulated ones. But the idea is to have companies distribute earnings to companies in that form as opposed to some other form. And by the way, dividends, again, as mentioned before, are not deductible. So from the corporation's point of view, and I know that we have to kind of keep going back and forth, shifting the view here from the corporation itself to shareholders' point of view. The incentive is that corporations, consider as retained earnings and never pay dividends at all, and therefore never distribute earnings to anyone. And then we're going to get into, I think there's some examples a bit later about how some of this runaround can be done, and to avoid paying a dividend and making a deductible payment to shareholders, which may not be the shareholders' interest tax-wise, but certainly maybe the corporation's interest, and we'll get to that. Some of this has been a bit mitigated, frankly, with the Tax Cut and Jobs Act by bringing the corporate rate down from 39% to 21%. 39% was a higher rate than individuals were paying at the very highest rates. And so in most cases, I mean, there are obviously some things like credits and deductions and whatnot that reduce that to make the effective rate lower. But as the corporate rate has been lowered, it becomes a little bit less advantageous on part of companies to engage in some of these creative distribution methods. But nonetheless, they still exist, and it's something we should talk about. Okay, all right. I was about to ask if anybody has any questions, but again, this is not a live broadcast. So okay. And for most individual taxpayers, the dividends again are subject to 15%. The various highest taxpayers pay a 20% rate, and the very lowest income taxpayers have a 0% rate. And in fact, this is what makes equity financing or equity ownership investment attractive to a lot of low income taxpayers. And we're not talking necessarily about people who have just very low wages, but a lot of retirees like dividend income, even if it's preferred dividends, because of the very low tax rate that they're earning, and it supplements their income in retirement. So, and that's oftentimes a real beneficial aspect. Okay. All right. So those are the marginal rates affecting corporations. And to qualify for the lower rates, and I think you probably, if you took tax one here, I think you probably could have used the same text. You got into this issue of qualified dividends and what qualified dividends are. It's nothing really too complicated, even though it comes up in tax returns. Certainly, I know as a person doing individual tax returns, people say, "What's a qualified dividend and what's a non-qualified dividend?" And if it's a publicly traded company that you're investing in, chances are probably pretty good it's going to be qualified. And it's any company that primarily trades on a U.S. stock exchange, even if it's not even based in America. There are lots of foreign corporations that will list their shares here in the U.S. primarily in order to get access to these very large capital markets that we've got here. And so, and it's also a way for the U.S. to sort of absorb these companies and absorb this capital coming from abroad. We like that. That's a good thing. And so as a result, qualified dividends are treated with a more preferential tax treatment. And then if it's in the dividend, they have to be this 121-day period here where the stock has to be held over 60 days during any 121-day period, beginning 60 days before the ex-dividend date. I know that sounds like a mouthful, but if you've held the stock for a long term, this is not even an issue. It really has to do with do we want to prevent somebody from buying a stock close to the end of the tax year, selling it at the beginning of the tax year just to get the qualified dividend at a lower tax rate. Instead, this is really to benefit longer term investors. And its dividends are paid to those who hold both long and short positions. There is a disqualification. A short position is basically where you borrow shares from your broker. You may be familiar with this. And you can't hold both long and short positions and then take the qualified dividend rate because you're really, it's just a public policy issue. You could argue that shouldn't be a rule, but like so much in tax, it's not really what things ought to be based upon our own perception. It's just the way things are. So that's kind of the way that is. And the dividends are not considered investment income when determining the investment interest expense deduction. So the investment interest deduction really applies mostly to people who borrow money in order to buy securities, and there are some exclusions that wouldn't apply. They can't buy things like municipal bonds because those are tax free, and then be able to claim the interest deduction. That doesn't work. So it also doesn't work in this case when you're borrowing money like a margin borrower, where you have 100,000 in your brokerage account, you borrow another 100,000, and you buy stock. You qualified. Companies that pay qualified dividends that would disallow that, except for the fact there is an allowance where you can say, okay, well, I will have those dividends treated as ordinary income, and yet therefore I will take the interest deduction in order to offset some of the taxable income. And you could do that. Now, how would you know to do that, or how would you not know to do that? This is why you have to have a tax account in order to do it. You just kind of have to figure out what the best treatment is, and you have to kind of work it both ways. In my experience, it's a very small percentage of individual taxpayers who borrow stock, who invest on margin. It's a little bit risky. There's some cost to it, and whatnot. That can definitely magnify earnings, but I haven't come across it a lot. I'm not saying I've never come across it, but it's not your average investor. And so when that situation comes upon you as a tax accountant, you really just have to kind of find out what the best treatment is for that. And by the way, when we talk about stock, and there are all kinds of rules that are specifically tax related, things like wash sales and whatnot. And this is where you really have got to understand what's going on with the taxpayer and do a drill down into it. There is no way I have time to talk about all the tax rules that apply to stock investing, but these are some important ones, particularly since we're talking about dividends to shareholders. And again, as I mentioned, excuse me, at the outset, that a lot of this chapter deals with tax treatment affecting the shareholders, probably much more than the corporations themselves, even though we're not ignoring obviously the corporations, but because the corporations are owned by the shareholders, shareholders are really a part of the corporation, so it becomes an issue. And very often, as a tax professional, tax accountant, you'll do tax returns both for corporations, particularly smaller corporations, as well as the individuals themselves who own them. So it's kind of a nice bit of business for you. And so understanding how all these things fit together is a real benefit. Okay. All right. So let's talk a bit about property dividends. I don't want to spend a lot of time on this because I think it's a little bit odd. I don't think it comes up all that often, but there are some effects when a company distributes dividends that are not cash dividends, or dividends of property like real estate or something like that. And it's taxable as a dividend up to the extent of earnings and profits. Anything over and above that is taxed as a return of capital to the extent of basis, and anything over that to the extent, anything over and above that is a capital gain, which is because your basis is exhausted at this point, and anything over and above that is capital gains. But you're going to reduce the amount of any distributed by any liabilities, and so this is where it gets a little bit dicey, where you have the basis of the distributed property is going to be assumed to be the fair market value of that property, and so the liability will come into play here. And there's an example here that we will look at. I believe it's in here in a second. We'll come upon it. We'll talk more about that. To the corporations, treated as if it sold the property at the fair market value. And if there's a gain, that is anything over and above its basis, that recognizes that. But no loss is recognized for tax purposes. For GAAP purposes, different story, but for tax purposes, not. But if it's subject to a liability, then the fair market value is treated. It cannot be less than the amount of the liability. So you can't reduce the amount of the fair market value beyond that of the liability that it attaches to. And presumably the liability goes off with the asset itself to the recipient of that. So that kind of makes sense in that regard as well. Okay. All right. And so the effect of the corporation, again, it increases E&P for any excess of fair market value over basis. That is, we do recognize gain, just not a loss. And we reduce the fair market value of any property distributed if there are liabilities, or minus any liabilities. And if there are liabilities that are greater than the fair market value, then obviously we can't make those unequal. They have to be exactly equal at that point. And they can't generate or add to any deficit in earnings and profits. But any deficits can only arise through losses, which are operating losses, or maybe specifically, operating losses. But operating losses kind of brings us back in the GAAP world. Any kind of net income losses, I guess, or net losses, I guess we should say. So that's what creates a deficit in E&P. So we're not actually reducing E&P in this regard. So here we have an example of, and particularly one that's interesting is scenario 3. So there's property that's being distributed with a basis of 20,000 in each of the following situations. Again, these are all three independent of one another. In scenario 1, fair market value is 60,000. There's a gain of 40,000 because the basis was 20,000. So the E&P is increased by the amount of the gain. And why wouldn't it be? Because there's a distribution of a greater amount than what the basis of that was. So, and then the E&P decreases 60,000 based upon the fair market value going down. Okay. All right. In scenario 2, the fair market value is 10,000, and as a result, there's no loss being recognized, no gain certainly being recognized, and we're simply reducing the property by 20,000, the earnings and profits by 20,000, the basis of the property. And then scenario 3, think about, this is a little bit interesting. It takes a little bit of time, maybe, to sort through. Maybe some of our minds work faster than others, but I had to kind of look at this when I first saw it. But think about the balance sheet effects here. The left side goes down by 20,000 because it's getting rid of an asset. But even though the fair market value of the asset is 40,000, okay. But the real action is going to be on the right side on the balance sheet. And even though this is not GAAP reporting, because E&P is a corporate tax concept, any gains here are going to go into earnings and profits, but not to shareholders' equity necessarily. Okay. So that's something to think about. So we will recognize a gain. 40,000 is the fair market value. and 20,000 was the basis of the property in the first place. And there's also liability on the property, and so the liability goes with it, and so the decrease in overall E&P is going to be 25,000, 40,000 minus 15,000, the liability itself. Okay, which makes sense because remember we're getting rid of a liability here, so that's going to reduce the amount of decrease here in earnings and profits. Okay, all right, let's see where we are now, and let's move on to the concept of constructive dividends. Constructive dividends is sort of it's a tax concept. It might not be something a lot of people are familiar with, but it's any kind of benefit that accrues to a shareholder that the IRS deems as a dividend, even though it's not actually cited or construed as a dividend, particularly by the corporation or by shareholders themselves, and need not be prorated, and doesn't necessarily have to satisfy the legal requirement of a dividend. That is, remember the legal requirements of a dividend are that the top management, if it's publicly traded corporation, is going to be the board, privately owned corporation, I suppose meeting of one, but where there's a dividend declared. Here, those rules need not apply if the IRS deems a dividend or a distribution as being a dividend as opposed to any other thing here. And it's usually the case, and I bring up the meeting of one because in a lot of states, corporations can be in a one-person entity. Doesn't have to be a sub-S, you can be a C corp. And so really these board meetings are sort of pro forma, having a meeting with oneself, in other words, and saying, I'm going to create a dividend and I'm going to treat it as a dividend. Okay. So it's usually closely held corporations. And in this case, the payments is considered to be done only to avoid taxes primarily. That is because there's a tax benefit to the recipient shareholder. And in other words, if it's a closely held business, I want to dividend myself $100,000 and then only pay a tax rate of 15% or whatever. That's going to be maybe lower than my marginal rate of 37%, for instance. And so as a result, I'm avoiding taxes. And so it becomes a little bit dicier. And this is where we get into the IRS reclassifying this as a dividend, which means the corporation cannot deduct or any kind of way that we want to take this out, whether it's a dividend or not. Actually, I think I sort of said this as if it were a dividend to begin with, but maybe it's a loan to me for some reason. Interest being deductible or whatnot. It's a way to suck out the equity of a firm and not call it dividend, but the IRS may consider it a dividend. So I apologize for that, and I get a little bit confused with what I was talking about there. But the idea is that that there's a recharacterization of it as a dividend, meaning the company cannot deduct the payment as an expense, but rather as a dividend, which means it's not deductible, and therefore the individual shareholder then does not get dividend treatment either. And so, as a result, well, they may get dividend treatment, but it doesn't really matter because it's a closely held company. So anyway, that's essentially what's going on there. So it's not a thing that comes up a lot. It does happen. What is more common is something that we're going to talk about here in a second, where it's some of these other issues where there are distributions, and a lot of it has the form of wages, I think. And this is probably the biggest issue, especially in my experience, where the IRS will consider it a distribution of equity as opposed to some sort of deductible expense. Things like the use of shareholder corporate property, particularly things like vehicles and whatnot, will come up a lot. Or some bargain sale of property where maybe they'll sell a building to a shareholder at a very much reduced price. Just a way of sucking equity out of business. One big issue is wages, and I saw this a fair amount. Particularly when I was in banking, even before I got into tax accounting, where it would often be a spouse of an owner who works in the business and earns an excessively large amount of salary for doing who knows what, sometimes maybe nothing at all. And then the question is, does this person have an office? Does this person have any skills to be making $300,000 a year or whatever the case might be? And is it really a distribution of equity out of this company to this particular owner, shareholder, spouse, whatever, and therefore should not be deductible to the company. And that's really the question: should it be then considered a dividend? And that becomes a constructive dividend. Here, the big issue, and this is why I sort of confused myself a bit, is we're really talking primarily about the effect on the corporation, much more than the effect on the shareholders themselves. Yes, dividends are treated differently from tax purposes, but the big issue concerns deductibility of the distribution in the first place. If it's considered to be something like unreasonable compensation, so somebody who has no office but is being paid as a secretary of the business, which is not an uncommon scenario, is that really a distribution of equity, or is that something that should be the tax deductible expense? The IRS may disallow that tax deductible expense, call it a dividend, call it a distribution of equity, which but then has the effect really of bringing down earnings and profits. And so then you get into lots of other issues in that particular regard as well. So, and there are a lot of issues that affect particularly small businesses. And we talk about unreasonable compensation. And let me go back one here. And we talked about this in the case of, are we really paying somebody too much to do whatever it is they're doing? And I think we alluded to this a bit in chapter 18, where we said that there's this issue the IRS has long had about something called reasonable compensation. In this case, unreasonable compensation is considered maybe too high. As we get a little bit deeper in the course, we'll talk particularly when we get into some of the pass-through entities like sub-S corps about reasonable compensation being unreasonable compensation is that which is too low. And we'll talk about the reasons for that in a bit, and that's sort of coming up. So unreasonable compensation in this context is that which is too high. And one would have to consider, is this employee qualified to do something? Do they have any kind of experience in this area, any kind of training, any kind of education? Does it make sense with other people in some other industries based on what they do? Does this make sense that we're paying this person to do something, whatever it is, an excessively large amount of money? How big the business is, what kind of business it does, what exactly the work is. And so a lot of these, it's hard to sort of categorize these and take one only. I think it's got to be sort of a combination. And it kind of goes back to this idea of what we call facts and circumstances. What are the facts? What are the circumstances? Does this make sense? What is the employees? What is the wage rate for this person in relation to other people as well? And again, in smaller companies, what's been the history? Have we paid this person relatively the same amount in previous years for the same work? Why is this person now earning $800,000 a year when they're earning $50,000 a year the first a year prior? Does that make sense? How are we paying other workers? All these sort of facts and circumstances. And this is what makes tax accounting a little bit tricky. And this is why judgment and experience make a difference when it comes to preparing returns and also to advise clients, as corporate clients in this case, how to handle some of these distributions. Okay. In order to stay out of trouble. And again, I hate to say it, I hate to put it this way, but it's a matter of, I guess, being caught, I suppose. I don't know any other way to put it. The IRS might not raise an issue unless there's something that really flags the IRS's their attention. But it's best to sort of avoid that particular issue because tax trouble is something most companies don't want, and particularly when it looks like there's a tax avoidance issue. I think that's something that the IRS frowns upon, to put mildly. Okay. Also, loans to shareholders are also. Is it a backdoor distribution of equity? And is it bona fide? Is there a written instrument that talks about what this is? We got into this a little bit last time as well in chapter 18. Is there collateral? That oftentimes, a lot of times loans are evidenced by collateral. What are the terms? Are there any formal repayments being made? Is there interest involved? What is the purpose of it? Is there a reason? Now, loans to shareholders, there's nothing inherently wrong about loans to shareholders. This happens somewhat frequently, and we see this happening occasionally, particularly, and I go back to this example of professional firms like accounting firms and law firms where partnerships are offered to former associates and say the partnership is we're not in partnerships yet, or ownership, let's say in this case, is offered to previously lower level folks who are considered key people, but they don't have the cash to buy into the business, and so a loan is made to them. and then out of their wages and or bonuses or both or whatever, they can make a repayment on some sort of regular schedule with interest, and that's fine. It's perfectly recognized, and it does happen. And there are all kinds of other reasons why loans to shareholders may happen. But if it looks like it's a distribution of equity as a way to avoid taxes, particularly from the corporate standpoint here, then that might be an issue. Again, some of these, these strictures against these distributions were probably a little bit more relevant before the tax code was changed in 2017. But then again, the tax law may change again, so we have to kind of be vigilant. I think the IRS is a little bit less vigilant on these topics than they used to be, particularly given the lower corporate tax rate, the lower incentive to do these kind of things. But nonetheless, these are things that are on their radar. Okay, stock dividends. We talked a little bit. Stock dividends. We talked a little bit about stock rights. Whether it's a stock dividend is simply just a distribution of more stock to particular owners. If it's not a taxable event, earnings and profits is not reduced. If it's taxable, you're going to treat it as income. Okay, my projector went dormant there. I gotta remember to move the cursor a little bit. So hopefully I didn't lose anything. I hope we're still recording here. But stock dividends, it's basically equivalent to the basis of stock received. I'm just kind of flipping around and making sure that I'm still online. If they are taxable, then the basis of the new shares is considered the fair market value, and the holding period begins on the date of the receipt, and that's essentially if it's new shares. If they're old shares, then the basis goes back to the original date, and so and whatnot. So anyway, stock rights and stock dividends based upon this, and so the value of the rights received are less than 15% of the value of the old stock, then the basis and rights are zero. That is, there's no basis, and so those are some issues. You can kind of look through those for yourself and talk about what those, look into what those are. Stock redemptions. Let's kind of move on to this issue of stock redemptions. And when we're talking about redemptions, we're talking about sometimes are they treated as dividend treatment, or are they considered sale or exchange treatment? And we have to really determine what these are. They're treated a bit differently. So, and what are stock redemptions? Basically, for a lot of different reasons. If it's a publicly traded corporation like an IBM or Apple, or whomever, these companies will sometimes buy back shares for all kinds of reasons. Maybe they feel like the current share price is below what they feel is the fair market value in their opinion. So therefore, they can buy it back down and reissue those later at a higher price. That might make sense. It also reduces the number of shares outstanding, and therefore sometimes boosts the stock price. And we've seen lots of stock buybacks in recent years. In closely held corporations, particularly non-public companies, they simply might buy the stock back from somebody who's died, or if somebody is leaving the business for whatever reason. And again, this is an individual liquidation, not a corporate liquidation. Or sometimes, very often, when divorces happen, these kind of things happen. Now, sometimes the corporation just may reorganize altogether in the event of a divorce. The laws differ among states. New Mexico, being a community property state, makes this a little bit more incumbent. This idea of paying off a spouse. Other states that do not have a community property law is a little bit different, but that gets into those issues. Again, would very definitely be the facts and circumstances sort of judgment as to how those are to be treated. But if it looks like a dividend, then the redemption is not going to be considered a qualified dividend. So in this case, if the shareholder owns the entirety of the corporation and the corporation buys back half of their stock, the shareholder still owns 100%. So in this case, it's all it is simply an exchange. Really, nothing new is happening. And certain kinds of redemptions are not allowed what we call the sale or exchange treatment, particularly when it's in complete liquidation. And we're going to talk a little bit more about that as we get into chapter 20. But that's essentially what's going on. Stock is redeemed for all kinds of reasons, and and they really differ between public and private corporations. In publicly traded corporations, it's been a big trend in the last several years, and we saw the government, particularly the Biden administration, look very unfavorably on some of these, frankly, particularly at the publicly traded level. So what do I mean? If it's not qualified, what does this mean? Then basically it means the shareholder reports this as dividend income, and they can be taxed at whatever their tax rate is based upon their income. Again, this progressive tax structure on dividend taxation just simply applies to dividend taxes only, and we just don't know what it's going to be because we don't know what that individual shareholder situation is. But it could be if it's zero, then well, okay, that might not be an issue, right? But the redemption proceeds can't be offset by any basis in stock that's basically given back up, okay? And we can't offset it by any capital losses one. And so, and as I mentioned a minute ago, okay, if it's 0%, well, maybe you prefer the dividend treatment. So, or if you're a corporation, maybe the dividends received deduction makes the dividend treatment acceptable. So, one of the things that I think is, I guess maybe it's a criticism, I suppose, is the text sort of assumes that nobody wants dividend treatment, not the corporation, not shareholders. And that's not really always necessarily the case. I think it really depends upon the situation at hand. And so this idea that somehow dividends are maybe a bad thing, we want some other kind of treatment, is not always the right default setting that I think we'll look at. So, all right, so when we talk about distributions, in the text, there is, it's concept summary 19.4, if I can pull it up here for you, that you might want to look at. Yes, I'm still here. And this talks about different sorts of transactions. Section 302 of the code is really the operative thing to look at here, especially 302B. And you just have to kind of look at it and talk about what are the exact circumstances. And it's a lot to go through, and I think you really have to sort of determine what is this transaction about? What is this redemption all about? And how much of the redemption, or how much of the stock is being redeemed by individual shareholders, and what it's about. So I refer you to that if you want to get a little bit more background on this particular issue. Okay. And some distributions are treated as a redemption as opposed to a dividend, and that could be when a shareholder is simply, liquidating their entire interest, or a partial liquidation where the shareholder itself is an individual and whatnot. So the facts and circumstances really determine what is to be ascertained there. Okay. All right. So we've got a little bit more to do here on this in this video, and we'll talk about stock attribution rules and what this is about. And this is a little bit less obvious as opposed to some of the other concepts. The concept of stock attribution is essentially designed to prevent tax avoidance by parties who are closely related owners of the business. And again, this idea of tax avoidance is okay as a general concept. Now, there are some instances of tax avoidance in which the IRS may disfavor that tax avoidance and may disallow it, but it doesn't put somebody in a tenuous situation legally or facing penalties and fines necessarily. There may be interest in one of the penalties that may accrue, but nothing in the form of any kind of criminal treatment. The tax evasion, as opposed to avoidance, definitely is. And so tax avoidance, tax evasion, two different things. Tax evasion is where we basically are trying to avoid taxes in an illegal, unethical sort of manner, and really pushing the envelope. And again, I know back from my early days as an undergraduate in accounting, where we were sort of encouraged to push the envelope a little bit, but not break the law, but rather be a little bit aggressive at applying the rules. In fact, the IRS itself will say, okay, if you're entitled to a deduction, take it. If you're entitled to a credit, take it. Don't take it if you're don't try to claim it if you're not entitled to it. So pushing the envelope does not mean violating the law. I think the two are different, and maybe that's not always the case. And so stock attribution rules basically say, okay, what is this distribution? And are we, the IRS in this case, going to reclassify it based upon all the facts that are going on, oftentimes having to do with people who are related to one another, and That's oftentimes what's happening. In this case, if it's an individual who owns the stock and they're redeeming their stock, and yet it's really a family business and whatnot. So, are they really disposing of the stock? That is that really what's going on there? Or an estate or trust where a beneficiary is actually deemed to own the stock, and it's really not the estate or trust itself. And so the family attribution rules can be, ignored or not applied when there's a complete termination of the shareholder's interest. And so that, because the shareholder is leaving the business, everything's gone, and there are some rules about how long they're going to stay away from the business, but they don't apply in this case when people are leaving. But they may apply in the case of partial liquidation, because what is that redemption that's going on? What is this distribution? Is it a dividend? How is that to be treated? And so if it fails to satisfy these, it could be treated as an ordinary dividend, which again is maybe not the end of the world, but the basis in the stock that redeems goes to any of the remaining stock owned, whether it's directly or constructively, as in other family members, primarily spouses, being a big one, but more likely children and that sort of thing. And non-qualified redemption can result in basis going from one taxpayer to another, and so that results in some disparate treatment that may not have been expected when the redemption happens. So under 302B, a redemption qualifies for the exchange treatment if it is not a dividend, if it doesn't qualify as a dividend, and it's subjective, and again deals with the facts and circumstances. And there was some also provision that was specifically to deal with preferred stock, and the subjective test means that all these facts and circumstances need to be understood. Preferred stock, sometimes shareholders in preferred stock situations don't have any control of the redemption. The company's buying back their stock, and that's just the way it's going to be, because sometimes preferred shares, they're a lot more like debt instruments than they are equity. Even though I know they're sort of defined and thought of as being sort of hybrid debt equity instruments, but there are redemption privilege provisions, because sometimes the interest rate that is implied in the dividend is too high considering what the market environment is, and so companies say, I want these shares to go away, so we're going to buy them back. And so in this case, the preferred shareholders have no say in the matter, but it can also apply to some redemptions of common stock. And again, any initial issue of shares have got to be considered common first, and then preferred have to be specifically identified as being preferred shares. And in this case, any kind of redemption to qualify for this treatment, redemption has got to be a meaningful reduction in the shareholder's interest. Okay, and in other words, a decrease in their voting control, and a reduction in rights to any kind of dividends or other kind of earnings and whatnot. So anything which is not disproportionate is probably going to be considered more of a dividend. And there's the 80% rule that says that if the shareholder owns less than 80% of the interest owned prior to the redemption and 50% afterwards, and that may qualify. But that's a pretty good rule of thumb. You can kind of look that up for yourself. Okay. Now, what does this really mean then? Well, so what does it mean if it's disproportionate? It doesn't qualify in this particular case. It just simply means if they don't meet the disproportionate redemption test, then the distribution is treated as a dividend. Okay. And again, that might not be the end of the world, but that is essentially what the default standard would be in this case. It is considered to be a dividend, so therefore, to the corporation, it's treated as a dividend, which then has an effect on earnings and profits. To the shareholder, it's considered to be a dividend, and it goes to that. And these are very complex rules. These are not easy, and we just have to kind of look at them, particularly when it comes to what this means after the IRS may determine that this is not qualified. What does this mean as to the basis of shares that remain, and particularly the shares which are attributed to others? And so we have to kind of take a look at these as well. So, and then if there's an entire interest that generally qualifies, the family attribution rule. So there's an exception for family attribution rules where the shareholder who is not considered a creditor for at least 10 years, is considered a creditor. They can lend money to the company, they just can't own part of the company. Okay, and this is sometimes a difficult thing because are they really an owner, even though they're a creditor? But not for at least 10 years after redemption. And they also notify the IRS within 30 days if there is any new interest acquired within that 10-year period. In other words, that we are going, this person's going away, they're not coming back, and whatnot. So, and this does happen where people leave a business and don't come back, and the family, so it does not attribute any shares to the individual family members after that point. Okay, so and taxpayers may want to seek, in this case, what we call a private letter ruling from the IRS with before proceeding with the transaction. And I think this is probably a good thing to do with the district office. The key test is whether a particular business endeavor is disposed of this if the shareholders are paid off with respect to a particular line of business. And private letter rulings are simply requests of the IRS to say, how is this to be treated? And if the IRS has all the facts that they feel like they have, but I mean, it's not, you can't rely upon a private letter ruling if the IRS says later, hey, we didn't know about this or whatever. But if they have all the facts, that becomes binding on the IRS that they will honor that particular treatment. So that's something that CPAs, tax attorneys, EAs can look at as an option, particularly when you get some of these dicier situations. And keep in mind too, that a lot of companies have interlocking shares and whatnot, where you have companies owning parts of other companies and whatnot. So the amount of complexity involved in corporate tax just goes on and on. I hope I don't think that anyone here is that fact is lost on anyone here, but some of these have to be sort of pulled apart. And we haven't even gotten into things like estates yet and whatnot, but you get the idea that I think it's really incumbent upon tax professionals in order to really get a reading on how these should be handled. Yes, we want to be aggressive. We want to try to maximize the tax or our clients' benefit, those of us who are in the tax profession, but we clearly don't want to break the law. We want to do as much as we can, but sometimes we just sort of need guidance, and this is done in a written format. And you know, hopefully the IRS is going to be as receptive to that in years going forward. I know there's some cuts to the IRS being made, but hopefully that won't impact the ability of the IRS to be responsive in this regard. It's better to know upfront what's going on rather than find out later. You know, some months later when you get a letter in the mail, and if you're a CPA, you definitely will hear from your client who runs into your office with her hair on fire with a letter from the IRS. And so, but generally, this is not something to freak out about. It's just something we need to deal with. But when they're complicated, let's try to deal with complicated things up front. So, okay, let me see. I'm not going to talk much about more about the partial liquidations. Redemptions to pay death taxes. All right, let me just talk a little bit here. This provision exists essentially to allow for a decedent's estate or heirs to obtain liquidity to pay funeral expenses, legal fees, accounting fees, not all what we call final expenses, but these sorts of administrative expenses, you know, and also death taxes. And personally, I hate the term death taxes, but nonetheless, it's a term that is used within the textbook, and a lot of times people know it. But one thing that occurs to me here, and it's something that if I were CPA doing taxes for a client, I would always recommend life insurance because it provides liquidity upon death, particularly if you have complicated holdings, which may get tied up in either probate or some estate proceeding and whatnot. Obviously, this is independent of the whole idea of companies buying key person insurance on individual key officers or employees, but for individual shareholders, you can't do it with taxes. You're going to have to pay the taxes. But sometimes your liquidity is tied up sometimes, and a lot of times a lot of people's net worth is in the form of shares in the business, particularly if that person is, becomes deceased in an untimely manner, like in their 40s or whatever. Most people expect to live longer than that, but as a result, this is why life insurance is so necessary. It's something that I know I advise clients a lot to make sure they have adequate amounts of life insurance. Doesn't mean you have to have the most expensive kind, so the whole life and universal life, but something that makes sense for you and something and it needs to be thought of. Okay, all right. And then a couple more, then there's a sort of a tax planning bit here. When we talk about distributions, we do want to talk about, or redemptions, we're talking about the effect on the corporation and whether there's gain or loss recognition. If there's property other than cash, then the corporation is going to recognize any kind of gain if there's an appreciation that is a fair market value over and above the basis. The loss, however, is not recognized. And so what a company could do is sell the property, take the loss of the property, use the proceeds for the sale for the redemption. This is not an unusual idea, rather than simply redeem stock or property for stock. Personally, I think this is a better way to go. I think that exchanging property for shares is complicated. First of all, there are valuations issued. What is the value of the property, and according to whom, and does it depreciate? I mean, what exactly is the property? Does it even make sense for a shareholder to receive property? Would they want to do that? And it kind of goes back to 351 treatment that we talked about in chapter 17. Maybe you don't want to transfer property in exchange for shares. Maybe you just want to liquidate the property, take the cash, and then buy the shares. And then there's no issue of deferred whatever, no gain, no deferred loss. Obviously, a deferred taxable gain might be advantageous, but then again, maybe it's not in your wheelhouse. Maybe there's a lot of cases. There are a lot of cases which people just simply want to get their tax obligation out of the way and don't want to leave it down the road for someone else to perhaps deal with and try to understand it down the road. So anyway, so the corporation could do that. This is from the corporation standpoint. I only bring up 351 treatment because I think it's analogous to this idea of, do we want to always exchange property for something? That may not always be the case. And in fact, my experience, particularly when I was in commercial lending as a banker, is that very few transactions involve exchanges of property for shares or vice versa, except in the case of like-kind exchanges, which are primarily associated with real estate transactions. But then again, if you're not really dealing much in real estate, that's not for you. So, all right, so the effect on earnings and profits, if it's a qualifying redemption, the earnings and profits of the company is reduced by no more than the percentage of the corporation's stock redeemed. Okay, and that makes sense. And then expenditures that are not deductible are, in this case, just for the redemption of things like accounting fees, brokerage fees, and whatnot, legal fees, etc. There may be an excise tax. And by the way, the excise tax, which is a non-deductible tax, was something that came up during COVID, and this was sort of a pushback against companies buying back stock, where there's a tax the corporation now pays to those companies to which it applies. And again, you can look up the definition of covered corporation. It's not every corporation, but it's a 1% excise tax that applies to the market value of the stock that's being bought back. It's being redeemed in this case, and that's something that's fairly new. Now, I would not be surprised if this goes away with the revision to the tax cut. Well, the Tax Cut and Jobs Act expires this year. I would not be shocked if this goes away. I can't say for sure, but if I were going to bet, I would say that might very well go away. We know the Biden administration was not keen on these stock redemptions and these stock buybacks. And again, a lot of times the public policy imperative there was maybe the resources can be directed more toward employees as opposed to owners. But then again, debates over everything are never going to stop and ever. So it just depends on one's point of view. So the stock, these are not subject to tax. That is, when the total amount repurchase is less than millions, and this is what is not subject to that. All it is done as part of some broader and reorganization, which is demonstrably a reorganization. There's no gain or loss recognized on it as a result of it. A lot of companies will do this, just reorganize or do things in this regard, or when it's done in the context of some sort of employee plan, like a stock ownership plan. A lot of companies have stock ownership plans where employees can buy stock or be given stock, excuse me, as part of their compensation. And so in that case, that would not be subject to it. Again, it's very much a employee favored kind of concept. And then one final bit here is about sort of a tax planning bit. And I know one of the things that I personally think is something we need to maybe stress more in this course is the idea of tax planning and how we help clients. And maybe it's a bit beyond what we're trying to do here. Obviously, there are other tax courses that, for those who want to specialize in tax, can take. There are masters in tax courses, or programs, I should say, master's programs and courses, which get into a lot more of this, and where there's a lot of case study, individual examples, by which tax practitioners can be exposed to various strategies for advising clients, particularly corporate clients, because tax situations are a lot more complicated. I think most accountants, tax preparers, CPAs, and enrolled agents are probably able to handle most individual situations. Maybe not states trust so much, but individual situations. But corporate tax situations, a little bit difficult, more difficult, and some of the provisions really have to kind of be studied. And in addition to that, sometimes case law has to be consulted as to what the most recent standing of the courts, position of the courts are in their standing as to some of these tax concepts. So, but one bit of good advice is to maintain ongoing records. And I think your text talked about the fact that some companies don't calculate the NP or keep an accurate record of it, and that's not a great thing. There is, again, the IRS does not have a statute of limitations, and they can always go back and say, recalculate earnings and profits. And rule of thumb everywhere in accounting is the further back you have to go in order to research things, the more difficult it is. And you have software that is not compatible with current software. You've got statements that are, if it's physical documents, some of them are missing or illegible. People who are involved in decisions are no longer around. So it's a good idea to sort of keep good records as one goes. This is why a good tax software program, which there are many out there, are really indispensable, particularly for a corporation of any size. And also, the adjusting the timing of tax treatment, it might make sense in order to make any distributions by the end of the year, if you want to achieve a certain effect as opposed to the beginning of the next year, particularly if it involves something like a return of capital as opposed to a dividend treatment. So it's a timing issue. That's something that is some advice. Hey, when do I want to make this distribution? Well, let me tell you, based upon where we are now with what we expect current EMP to be, et cetera. Okay. And then things like qualified dividends, if they're retirement plans. This really deals more with, I think, individuals in this case, particularly individual shareholders. And so again, we sort of are weaving in and out between corporate issues and individual issues. But when we talk about the reduced tax rates that apply to dividends in particular, and I know that the textbook has this sort of maybe jaundiced eye toward dividends. But as it applies to individuals, most people would prefer to get a dividend at that tax rate than interest, for instance, in that tax rate, which is higher. But these are not available when stock, for instance, is held in something like a traditional IRA, 401k, something like that, because all the distributions are, whether they're distributions of gains, dividends, whatever, it's all treated the same, because there's I think the IRS has long ago given up on the idea of trying to figure out what is what as a distribution comes out of, say, a traditional IRA. Is that there's no way to figure out, was this a gain that you took back in 1990 or whatever? I mean, it just is really, really hard. And in what order do you take them? So they're all taxed at ordinary rates, and so that doesn't make really any difference at all. So when we're talking about qualified dividends, that may not be really an option at all. In fact, dividend, one of the downsides to tax deferred retirement programs is the idea that you don't get the reduced tax rates on dividends and also long-term capital gains, because the dividend rate and the long-term capital gain rate are lower than ordinary rates in many cases. In fact, in most cases, I would say. So so that's one of the downsides. But then again, you have to balance that with the tax deferral of current contributions, as well as other, as accrued earnings over time. Personally, I'm a big fan of these programs, IRAs, traditional IRAs, 401ks, and whatnot, especially 401ks, particularly when there's a match provided by the employer. These are private employer programs and whatnot. As to the alternative minimum tax, these low rates also, there are low rates on dividends and long-term gains apply to both the regular and the alternative tax rate. So alternative minimum tax, we got into, I think we got into a bit in 2320. I don't teach it, but the AMT is simply this alternative, or I'm sorry, this parallel tax code that sort of runs in the background. High income taxpayers sometimes find they or have some things excluded, so they have an additional tax to be paid, and the difference between total tax paid and what under the ordinary system is called the AMT. So kind of being aware of this is important, and I think they probably did a poorly inadequate job here of describing what's going on with AMT. What we're really saying is just kind of be aware of what alternative minimum tax treatments might be for individual filers in this case. Okay, those are corporate AMT as well. We'll talk a bit more about that a bit later. And then with closely held corporations, they do have discretion regarding their dividend policies. They can increase dividends, they can quit paying dividends, they can do quite a lot of things. And but again, as we said before, shareholders might prefer dividends because of their preferential treatment, and particularly in a closely held company, maybe you'd rather be able to have it treated as a dividend if you're a shareholder. And even on a C corp, yes, there's double taxation, but they might prefer dividends in that regard. So, but again, this issue of the differential treatment of corporate tax rates and individual tax rates brought about by the Tax Cut and Jobs Act has made some of this a little bit less essential as a problem. Okay, and also one thing that could be done, particularly, and by the way, this might be applied to even things like dividends, not just dividends, but things like loans to shareholders, loans from shareholders, things like renting property from shareholders, which is very, very common. A lot of times, key shareholders will own a building and they'll lease the building to the company and whatnot. It might make sense to have what's called arm's length transaction, where it's basically the market rate that strangers would agree to, and so as a result, that would keep you a little bit out of trouble there. Particularly if the issue is, are we trying to excessively remove equity from the business by calling it a debt, like you're charging double the rent that you might charge another business simply because it's a closely held business, and so this arm's length. This is one of those facts and circumstances tests that apply to these that determine how the IRS is going to treat any kind of these distributions. Okay, all right. So this does it for chapter 19. I hope we've covered everything that's critical here. As always, feel free to get with me if you have questions. More than happy to answer your questions. We'll get into chapter 20, dealing with liquidating distributions, which is going to be a fascinating set of topics as well. But anyway, feel free to reach out to me if I can help you. Okay, thanks.